Hi, good evening, everyone. I'm Colleen, and on behalf of CGS-CIMB Securities Singapore, welcome to this webinar. We are here this evening to find out where are we along this economic recovery and spot the opportunities together. We will begin the session with a short discussion of macro outlook by Jeremy from CGS-CIMB Research, followed by a session of how investors can identify opportunities in the financial markets by Jay from Nasdaq using their point and figure charting methodology. It is a logical, organized way that helps to uncover the imbalances between the supply and demand in the stock market. Before we start off with the real stuff, please take note of the disclaimer on screen. Tonight's webinar, right, is purely for educational purposes and shall not be relied on as investment advice and acted upon. We will do our best to present the information as accurate as possible, and we shall not be liable for any investment losses due to any inaccuracies of the information presented. Okay, so during the session, right, if you have any questions, do not hesitate to raise them in the Q&A function that you see on your Zoom platform. We will do our best to answer most, if not all, of the questions after the presentations. Without further ado, let us welcome the first speaker for this evening, Jeremy Ng, our market strategist. Jeremy, right, he has been in the financial markets for more than 10 years, having worked in various stockbroking firms. He focuses on global macroeconomics, tracking the long-term trend, and employs technical analysis to time the entry and exit of the market. He is also the person behind our research report named the Transporter for US and Singapore market, which is also published on the Bloomberg terminal. Without further ado, let us welcome him on. Jeremy?
All right, thanks, Colleen. Let me share my screen right now. Okay, very good evening to everyone. Hope you guys can see the slide clear right now. So again, thanks for the introduction, Colleen. And for my part today, I'll be running through briefly what the US market outlook entails. Mainly right now, as you can see on your screen right here, we believe right now we are in this Goldilocks environment where it kind of sets a setting whereby probably we are looking at a start of a new bull market after what we saw kind of a major sell-off and panic alone in the March, April, May kind of a lockdown, pandemic kind of a sell-off. So I explain more in terms of what I mean by the Goldilocks environment. So just hang on. But basically right now, we are pretty bullish, at least in the longer term perspective, probably talking about the next 3 to 5 years kind of a circular trend. And in between, probably you could see some near-term sell-off, which I would kind of recommend people to kind of use that as an opportunity to buy the dip and accumulate more, especially if any kind of sell-off do actually comes into play in the market. So just hang with me. I'll run through very quickly and hopefully you guys can get something useful out of today's presentation. So again, a standard disclaimer here. For today's webinar, I'll be running through 3 big parts over here. And mainly, I think the first one that most investors right now are overlooking will be the current COVID-19 pandemic outbreak trend. Right now, with the recent vaccine news that came out just last week, and alone this week where we saw kind of 2 new news coming out from both Moderna as well as from Pfizer, reporting strong effectiveness from their vaccine north of 95%. It's kind of safe to say that probably the risk of the pandemic getting worse, at least going out to next year, is pretty minimal right now, with the vaccine being so effective. So that will set at least the longer term perspective of where we are seeing the economic growth probably pushing through strong ahead in 2021. But that doesn't mean near term we would actually see this recovery playing out so strongly. So I explain more in terms why we see probably the market could see some near-term sell-off, at least for probably the next 1 to 2 months before seeing the bull market catching back up. mainly stemming from the second wave of outbreak getting worse. And then from a longer term perspective, we believe both from the monetary policy as well as from the fiscal policy, that will more or less set the tone for the longer term outlook for the next 1 year to 3 years time frame out. And we believe the support from both the fiscal side as well as the monetary side from the Federal Reserve will more or less kind of put in a floor for the overall market as and when we actually see some sort of a correction of more than 10 to 20%. So we have that kind of a long-term view whereby any sell-off, at least severe ones that we talk about, probably some knee-jerk reaction downside in response to some sort of a negative news, we believe as and when we see anything more than 10% sell-off, that is when the Federal Reserve actually step in and provide some sort of additional monetary stimulus program to kind of bolster the market and keep the market from actually falling lower. So that would set the tone. Near term, we see probable kind of a short-term correction, followed by the bull market catching back on. And last but not least, we'll talk about some deep buying strategy that kind of for traders, for investors can kind of employ within their trading arsenal to kind of time the market. So let's just jump straight through into the webinar today. So again, like I mentioned, the COVID-19 trend seems to be getting worse globally, mainly stemming from the European countries as well as the US. But over here, I'd just like to highlight what is happening within Europe. And mainly these are the countries that have actually implemented and imposed a new lockdown kind of scenario, kind of the second lockdown as compared to the first one that we saw in March and April. But mainly the main reason over here is because you can see the infection curve has been kind of getting out of hand, much worse than what we have actually seen during the first wave of outbreak during a March and April period. So for instance, countries like Germany, Italy, UK, France have actually reimposed lockdown measures starting, I believe, last month as well as this month itself. And you can see the main reason behind the lockdown is because you can see the infection curve is actually getting way out of hand, way worse than the first wave. You can see during the first wave, we are talking about a daily infection rate of a peak of around 7,000 to 13,000 from these European countries. But you can see the current wave is definitely way worse than what we saw in the first wave, where the infection rate on a day-to-day basis is as bad as 3 to 4 times the period that we saw in March and April. And henceforth, the government have no choice but to kind of reimpose this lockdown measure, mainly to kind of stem and try to curb the outbreak from getting out of hand. So right now, with that in mind, we definitely see the economic recovery coming up from these European countries to be definitely way less optimistic than what the market is expecting. And this new period of lockdown will most probably stifle the economic recovery, at least in this European country. And that will bring us to where we are here in the US. So you can see this alone is the US infection curve, shows you the day-to-day confirmed cases in the US. As of 17 November, this week, the total case count in the US is somewhere north of 11 million. But I think the main thing again to highlight is the daily infection rate. You can see we are talking about probably 3 different waves here. First wave again being in the March and April, where the peak is around 36,000. And then in July, we kind of get an extended first wave where the number actually hit a peak of around 78,000. And you can see more recently in October and November, the numbers just kind of skyrocketed, way north of 150,000, and even hit a peak of 190,000 per day alone in November. And again, you can see this particular pattern here in terms of the movement of the infection curve is pretty similar to what we are seeing here in the European countries, which is why we believe it's almost inevitable for the US to kind of head back into some sort of lockdown. Probably not a full lockdown kind of regime that we saw in March and April, as highlighted by Trump, and slowly transitioning into a Biden administration. Chances are we probably wouldn't see a full lockdown kind of scenario as stringent as the one in March and April. But nonetheless, some sort of a restrictive measure will most probably have to come into play, coming out probably in November or even December to try to kind of curb this particular outbreak that we have seen is kind of definitely out of control. And in fact, just this week, we have actually heard news from New York, kind of stating that they have actually closed schools, as well as restricting dine-in for customers. and also kind of closing out bars from selling out alcohol. So you can see slowly but surely, some states are actually slowly implementing some restrictive measures from the US. Again, mainly trying to curb this amount of outbreak. And I haven't really shown here in the chart, but the other more important data point over here in the US is the hospitalization rate has actually kind of skyrocketed to a new record high at the same time as well. So that is also another key important data to watch out for as hospitalization rate continues to creep higher. I guess a lot of governors will have no choice but to kind of take on some sort of restrictive measure to kind of curb this infection curve. So keep that in mind as we kind of roll back some of the reopening that we have seen in the economy. Chances are the economic recovery that we have seen, the optimistic view over the past 2 to 3 months will most probably kind of surprise to the downside. And we believe this economic shock, at least in the near term, the next 1 to 2 months out, will probably be some sort of headwind for the market. And that could actually cause the correction that I talk about in the equity market. Moving on, after considering what the COVID-19 trend is like from both European as well as US, this is also one of the more important charts that I like to highlight whenever I talk about macro outlook. So this is the economic surprise index from CT, basically tabulating the overall economic data that has been reported on a day-to-day basis from the US and tabulating them, showing whether they actually outperform or underperform the consensus. So for instance, any reading above 0 shows you a outperformance in the overall macroeconomic data and vice versa. And probably just to show you exactly how to use this particular indicator to kind of sense the economic recovery and then tying back to the equity market movement as you can just look at this particular point here in April. That is actually the period we saw this full lockdown scenario in US coming out in April. You can see this particular indicator actually hit a low of negative 144. Pretty much the all-time low for this particular indicator going back to the point where it actually came into light. And since then, we can actually see this strong, very, very strong V-shaped recovery. And you can see this strong V-shaped recovery actually coincides very nicely with the V-shaped recovery that we saw in the overall US equity market, be it in the S&P 500 index, the Nasdaq 100, or even the Dow Jones Industrial Index. So using this gives you a very good sensing in terms of where the economic outlook will be heading into for the next, probably the good 3 to 6 months out. And we saw the V-shaped recovery playing out pretty nicely here, feeding back to more than 50% recovery in the S&P 500 index. But right now, interestingly, if you were to look where we are right now, the index actually hit a record high. You can see pretty much a seesaw here from an extreme all-time low to an extreme all-time high here for this CT Economic Surprise Index. Actually, in July, hitting a high of around 246. Knowing that point being the extreme high, it's almost inevitable for this particular index to signal a period of correction, a period of mean reversion. And henceforth, in other words, it means that in the coming months, probably the overall economic data coming out from the US will continue to underwhelm the consensus, at least in the coming months, probably for the next 1 to 3 months out. Mainly, again, probably like I mentioned, because of the lockdown measure, reimposing on some of the reopening and more restrictive measure in the US that will actually feed back into a kind of a weakening economic outlook that we have right now, at least in the near term. And probably another explanation for this is that the base effect from the US, the easy part of the recovery is over because April was actually the all-time low where the economy actually came to a standstill into full lockdown. So coming up from the full lockdown kind of environment, it's easy to kind of outperform because of the low base. But right now, coming through the low base, we are comparing to a slightly higher month-on-month comparison. It's almost imminent that we could probably see some sort of correction here in the near term, again, for the next probably 1 to 2 months out. And probably just to highlight the kind of a historical performance of this particular indicator, I've actually marked up 2 horizontal lines here. And as you can see, this data go all the way back to 2003. The extreme high point for this particular indicator to kind of signal euphoria is when this indicator hit a half around 73. And you can see every single time when this indicator actually hits 73, which is like the ceiling for this particular indicator, you can see it actually goes through a period of mean reversion lower and kind of goes through a period of 3 to 6 months of a correction before this indicator turned back up. So you can see multiple times whereby once it takes the ceiling of 73, the extreme euphoric high, you can see the indicator actually falls lower, and which is why we are pretty confident to call for further mean reversion lower for this particular indicator moving forward, as we kind of head back into a more normalized kind of a scenario. So chances are we could probably fall below this 73 extreme high in the coming months, next 1 to 2 months out. And that could actually feed back to a kind of a market correction in the US market. And it wouldn't surprise me to kind of see the S&P correct just 5 to 15% during this period of economic kind of underperformance per se. And again, like I mentioned, the longer term perspective, we are very bullish. But in the near term, probably using this indicator as well as, like I mentioned, a probable more restrictive kind of a scenario coming up from the US economy to stifle the outbreak, chances are we could see 5 to 15% correction. And after which the positive vaccine coming out in Q2, Q3, reaching wider spread kind of adoption, that would actually fit back into a more longer term kind of a bull market. So just keep that in mind, our view is near-term correction, probably for the next 1 to 2 months, but probably kicking in 2021, that is when we will see probably the start of this new wave of optimism as well as a new wave of a bull market. Moving on, again, explaining why we think the worst could be actually over for the US equity market. Again, using the reference point from April and May, the full lockdown kind of scenario. That was when we actually see the US economy coming to a full standstill, whereby factories are actually closed. There isn't any factory production, any industrial production. At the same time, most of the services are being closed in US as well as the global economy. So we believe even during the depths of that particular full lockdown where the economic engine is kind of turned off, we didn't really see any kind of crazy default cycle in the likes of what we saw in the GFC. And with that in mind, if we actually went through that kind of full lockdown scenario without seeing that kind of credit cycle per se, the default cycle that is equivalent to GFC, chances are as we have actually moved out from the worst. And right now, again, like I mentioned, even if the US were to kind of head back into some sort of lockdown, it wouldn't be a full kind of a lockdown like what we see in April and May, where everyone is forced to kind of stay at home and only kind of being advised to go out if only for essential measures. We believe even with the next lockdown measure, with the uncertainty being cleared, with everyone kind of going through and experiencing what a lockdown is like, the next lockdown phase will be less stringent. There will be more flexibility per se, as long as we are kind of practice social distancing. And henceforth, in terms of the economic disaster or in terms of the economic disruption from the next wave of lockdown, we believe the repercussion and the implication will be less and way less bad as to what we have actually seen in April and May. So henceforth, we believe the worst is kind of over, and the period is actually in April and May. And moving forward, with more clarity coming out from the vaccine news, both from Moderna as well as from Pfizer, where they actually reported more than 95% efficacy of the vaccine. And with them saying that it could actually reach widespread means as early as Q2 and Q3 of next year, we believe the uncertainty, at least having cleared in mind with the safety in mind that the pandemic could actually be over next year, would actually feed back to better kind of a consumption behavior. And that could actually feed back better in terms of for the GDP kind of performance moving forward. So just keep that in mind. We believe the worst is over. But nonetheless, like I mentioned, near-term correction could still play out. 5 to 10%, 5 to 20% kind of a sell-off could still play out in the market for the market to normalize where we are right now with the recent euphoria. And longer term, again, we expect the market to perform at least better with the economic recovery kind of playing through for the full period in 2021 and onwards. However, that's not to say if the key caveat over here is if the virus actually mutates into something that's more infectious as well as more deadly, then that could actually be the black swan that nobody's expecting. Because right now, nobody knows exactly how the mainstream or the kind of herd mentality will kind of behave with the vaccine. And any major sell-off that could actually play out, it could actually stifle, comes out from actually a mutation of the virus, which we kind of deem a very low probability event. but just keep that back on mind. If the virus does actually mutate to this particular form, that could actually feed back into a more severe market sell-off, probably similar to what we saw in April and May. But again, we keep that to a very low probability event, but just keep that in mind as a low probability event outcome. And then moving on to economic cycle, this is also one of the slides that I actually like to show from a very kind of a longer term view as to pinpoint exactly where we are in the economic cycle. And again, economic cycle plays very well if you know exactly where we are in the expansion phase as well as the recession phase. And just to reiterate again, what this cycle shows is the market or the economy tends to move in this cycle of expansion and then inevitably into a recession, which is a contraction, and eventually coming out from recession back into expansion, so on and so forth. So I've actually tabulated the data going all the way back to 1933. So we have ample data over here supporting this kind of a cycle per se, the expansion cycle as well as the recession cycle. And what we noted is during phases of expansion, on average, we are talking about expansion of at least 60 straight months of expansion before the market actually slips into a recession. And 60 years being a good 5 years of expansion. And usually during an expansion phase of GDP expansion, Q1Q, the equity markets tend to ride along very nicely in the bull market during this period. And similarly, obviously on the recession side, on average, the recession tend to last around 9 months out. And again, during recession, definitely we know the market tend to actually see pretty much a turmoil, panic kind of environment where the S&P 500 index will actually fall in the range of 50% or more. So probably just to bring our attention to the most bottom row over here. In February 2020 was when we actually ended the most recent economic expansion and was also the longest economic expansion in history at 128 months. And with COVID pandemic was actually the kind of a pin that kind of a kick off this recession starting in February. But again, with the benefit of hindsight, we actually saw 2 straight quarters of contraction in Q1 and Q2 of 2020. And interestingly, with the most recent GDP number being reported in Q3, where the GDP number in the US actually came out north of 30%, that has actually confirmed to us that the recession has ended actually in the US. And that is actually, again, marking a pretty nice average of 9 months of recession over here in the US. And right now, we are talking about starting in Q3 of 2020 in September, we have actually moved out into the start of this economic expansion. And what it means is right now we are in this early phase of this economic expansion, and we could at least easily kind of see the next 5 years of economic expansion moving out before probably the next recession cycle kicks in. And what it means for investors is probably, again, like I mentioned, in the very early phase of this bull market, that's usually when we see pretty strong bull market coming out from the US market, be it the S&P 500 index, the Nasdaq, as well as the Dow Jones Industrial Average. So again, the longer term perspective here in the US market is pretty bullish. The next 5 years out, probably we wouldn't see any more recession coming out. And I'll explain more in terms of what the monetary policy is doing here to prevent recession from kicking in. But nonetheless, again, like I mentioned, being the worst over and full lockdown scenario in March and April, chances are as we could probably see a good 5 years out before some sort of market turbulence kicks in. So that brings us to the probable Goldilocks environment that I talk about as the main header for the kind of my market presentation today. So what I mean by Goldilocks environment is mainly 4 points here. Point 1 being lower political uncertainty here with the US presidential election kind of behind us. Right now, being Biden, being the president-elect, and Trump still not conceding, we will know for certainty by 8 December the full result of the US election. But nonetheless, chances are Biden will be the next president in US. And we have seen the market actually cheering on a Biden victory, regardless of him actually proposing a higher capital gain tax, as well as a higher corporate tax for the US. And I guess mainly the market is overlooking that because of kind of a Senate that is still being controlled by the Republican. So nonetheless, even if Biden wants to actually enact a higher kind of a capital gain tax as well as a higher corporate tax, the House will probably not be able to pass that. on. So that particular environment would kind of still feedback a similar environment of low tax environment of what Trump actually did over the past 4 years, and that will still continue to support the equity market, kind of a bull market here in the near term. And then the next factor over here is definitely the accommodative Federal Reserve, the federal policy, monetary policy that's being fed up, mainly with low interest rate environment. Again, from a monetary policy standpoint, the Fed has actually given us the green light that interest rate will stay low at the zero bound for at least the next 3 years, a good 3 years, at least to 2023, before we see inflation actually move up above 2%. And that is the kind of expectation that the Fed has, that the inflation will hit at least 2% earliest in 2023. And even by then, the Fed would actually not immediately raise its interest rate, because they have mentioned that they are right now kind of adopt the average inflation targeting kind of a mentality, which means they would like to see inflation rate actually kind of move above 2% target for a period of time consistently before even thinking about raising interest rate. So it's safe to say that this low interest rate environment will be here with us at least for the next 2 to 3 years out, at least to 2023. And probably I will kind of say before, somewhere in 2024, before we see some sort of decision in terms of raising interest rate. And on the other side of things, the quantitative easing program, the monetary policy from the US, right now we are still doing 120 billion per month QE program. We believe the Fed will continue to support the market as and when it's needed to kind of increase their quantitative easing program if the market actually experience any sort of a market sell-off. So you have your kind of monetary policy backing there, and at the same time, you also have the fiscal stimulus coming out. Next one that everyone will be looking out for will be the next COVID-19 bill that right now still looks like it's going to come in by end of this year. We are talking in the range of 1 trillion here for the next COVID-19 stimulus package. And probably when that gets passed, chances are we will see another booster in terms of the positive catalyst feeding into this next wave of optimism in the equity markets. And last but not least, the more recent news that we saw, vaccine, that would definitely be a very positive news, at least in the longer term perspective. Again, like I mentioned, with Pfizer and with Moderna reporting effectiveness of 95% or more, chances are as moving out next year, probably we could be coming out from the kind of a dark storm of this pandemic and probably leading back to a more normal life. Probably talking about, again, moving back to tourism, kind of heading into a holiday kind of a scenario where we are actually being allowed to kind of, again, commingle in a bigger group. And that would actually feed back into a better kind of consumer sentiment per se. And that will feed back into a better economic environment for expansion moving on for 2021 and forward. So that is the Goldilocks environment that we're actually watching out for, at least from a longer term perspective. But again, near term, we could still see some sort of a correction here, 5 to 15%. I wouldn't be surprised. Again, mainly because for the US to kind of stifle the outbreak in the COVID-19 and having no choice but to actually implement some sort of a lockdown measure pretty soon. So one last important slide for, again, kind of reinforcing why we are still in this very early stages of this bull market and equity markets, is mainly stemming from the Federal Reserve balance sheet. So you can see here, the bottom panel here shows you the Fed balance sheet, basically the amount of QE that they have been doing. And then the top panel here shows you the S&P 500 index, mainly the cross performance of the very positive correlation here. And this data again goes back pretty far back to 2006, just to show you the parallel in terms of how the Fed will always have your back in terms of when the market actually experience some sort of a market crisis, market turbulence, as well as a black swan kind of event. So you can see, I'll just kind of run back in history what happened during the GFC. And during the depths of the GFC, when we see a lot of a default coming up from mortgage-backed securities, causing a lot of a new default wave, actually to a new unprecedented level. You can see the Federal Reserve actually came in and stepped in and provide ample liquidity to the market to prevent the S&P from falling out from the bottom. And in fact, you can see the pre-GFC low for the Fed balance sheet is around 911 billion. And after going through a few rounds of asset purchase program, first one being the Troubled Asset Relief Program, as well as after they announced the first QE program. First one being only 600 billion, pretty small as compared to the more recent one that we've seen, which I'll explain in a while. But nonetheless, you can see them boosting the balance sheet from 911 billion to 2.24 trillion, whopping 120%. You can see what it did to the equity market is actually it didn't really form a bottom in the S&P 500 index, but actually took some prolonged period before we see a bottom in the S&P 500 index, a low of around 666 points. And again, with them showing their hands that they are ready to kind of stand in and support the market from it actually falling out. You can see the Fed actually signaled to us the bottom here, and followed by a strong bull market, and then kind of confirming to us a start of a whole new bull market and a whole new economic expansion phase, which I talked about, that lasted actually 128 months here with this most recent economic expansion. And you can see in between the first QE program all the way to QE3, the Fed actually expanded its QE again in March of 2018 to a size of 1.05 trillion, as well as in 3rd November where they announced QE2, 600 billion. You can see there is actually ample liquidity that's being provided by the Federal Reserve to prevent the market from actually falling over. And again, that actually fed back to a very strong positive correlation to the equity bull market that we actually saw since the bottom of 2009. So probably just to run through what actually happened in 2020 this year, where we actually went through a period of market sell-off when the unprecedented lockdown actually hit the market as well as hit everybody. You can see the S&P 500 index actually fell, if I'm not wrong, a maximum drawdown of around 33 to 35%. It's being shown by this particular sell-off here. Nonetheless, you can see during that particular market panic turmoil over there, you can see the Fed actually came in and actually stepped in to kind of support the market. And you can see similarly, they came in and do a new wave of QE program, QE4 in March. And then 1 week later actually announced something that's unprecedented, QE4, where there isn't actually a limit to that QE program. And in fact, if you were to see their balance sheet expansion, it actually rose from actually 3.76 trillion here to a high of around 7.15 trillion, which represent around 90% of expansion in their QE program balance sheet, which is pretty similar to what we saw in 2009 in the depths of the GFC. So it was no surprise that the S&P 500 index actually formed bottom around here in April, following the news of the Fed actually announcing this unlimited QE program that we have seen. And right now, we believe, again, this could actually be the start of this new economic expansion moving forward. And again, like I mentioned, with us being in a new economic expansion that could easily last the next 5 years, with the Fed actually still having a back, chances are we could actually see this trajectory playing out from 2009 to 2015 kind of trajectory. It wouldn't surprise me that the Fed balance sheet could actually go north of 8 trillion, 9 trillion, 10 trillion moving forward, just to kind of support the market moving forward, preventing it from slipping into another recession. So again, the long-term perspective for the US market right now is pretty optimistic. Again, like I mentioned, again, for the next 1 to 5 year period horizon. And again, for investors, it will be better for them to kind of capitalize if we actually see some sort of black swan market sell-off. Anything more than 10%, 20% would actually be a good point for entry to try to accumulate for the next wave of this bull market. And last but not least, after covering the economic expansion cycle, the COVID trend, probably just to add to your trading arsenal here for investors, for traders, a good way to actually time the end of a correction sell-off is to probably look out for points where you can actually time the end of the dip, end of the correction. And what I mean by that is, as you can see here, I'm using the S&P 500 index here as a proxy for the US market on the weekly time frame, which basically shows you every bar here represents a week. And what we noted is, if you were to look back, it's easier to time the market using a longer term time frame rather than watching probably the day-to-day movement or even hourly movement, 4-hourly movement. It's easier to time the end of a dip, the end of a correction using the weekly time frame chart. And you can see the red line here and the blue line here represent the 20 and the 60-week moving average. And what we noted is it's kind of good to use those 2 points, the 20 and the 60-week moving average, as a starting point for accumulation if and when a correction does happen. And a markup here, you can see quite a few green highlighted region here to show you exactly when to actually try to buy during a period of sell-off. And we believe in between that range, the red line and the blue line, the 20 and the 60-week moving average presents a very good starting point for accumulation to kind of ride the bull market back in. A good example here is in 2019, you can see very nicely how this 60-week moving average and this 20-week moving average actually kind of acting as a springboard for propelling price higher for the next wave higher. And even more so in the more recent market sell-off, alone in September and October, you can see the 20-week moving average actually kind of show you a pretty nice bottom to actually buy to ride along this particular uptrend. So moving forward, again, like we say, the near-term outlook that we have is probably some sort of a near-term correction for the next 1 to 2 months out. Probably a good correction point to accumulate is around the red line and the blue line, the 20 and 60-week moving average, which is around this point here, 3,175 points, which is the 60-week moving average, as well as the 3,370 points, which is the 20-week moving average, which we think this would be a good starting point for accumulation here to buy into the S&P 500 index or the SPY for the ETF per se. And this would be the trajectory that we will be expecting the S&P 500 to move into for the next probably 6 months out, 2 to 3 months for this correction, and probably 2021 to play the rebound back above 3,600 points or even above to 3,700 points. And probably similarly on the Nasdaq 100, it's pretty much the same. You can see here pretty much similar outlook here. Weekly time frame, the 20 and 60-day week moving average, the red and blue line, gives you a very good starting point for accumulation and trying to buy low kind of a mentality using the red line and the blue line. You can see in March, June of 2018, you can see the correction tends to end around the 20-week moving average, as well as in the 2019, June, September, and October each period, you can see similarly the blue line, the red line tends to actually give you a very good starting point to actually buy more into the kind of sell-off correction. And again, similarly in the more recent trend, after seeing this very strong V-shaped recovery following the recovery phase following the lockdown, you can see the red line, the 20-week moving average actually give you a very good starting point of buying the bottom here. And in fact, it actually signaled the bottom again in September and in October. So right now, again, with the expectation of seeing some kind of a near-term correction, we believe kind of the starting point for accumulation right now for the Nasdaq 100 or the QQQ for the ETF is around this range, 10,370 points, which is this support level, as well as where the 20-week moving average is around 11,220 points. So trajectory, near-term correction followed by a rebound back to the uptrend. That's what we expect in the Nasdaq 100. So just keep that in mind again. Using the 20-week, 20 and 60-week moving average does give you a very good starting point of accumulation in hopes that the uptrend resumes. So I hope you guys can kind of just add that into your chart per se and add that into a trading arsenal, and probably just monitor them yourself and see how it actually works. And probably you will kind of see how it works effectively moving forward when we actually end this next phase of correction. And last but not least, I will end this slide right now. And again, running through what we have in mind. In the very near term, we believe the second wave of outbreak in the US would likely cause some sort of a near-term correction first. And some sort of correction may coming in probably in the next 1 to 2 months out. Some sort of correction for the market, mainly due to the fact that the US have no choice but to re-implement some sort of a restrictive measure, some sort of lockdown measure that would actually cause the economic data to kind of underperform. And that would actually feed back into kind of some sort of a correction. 5 to 15%, 20% wouldn't be surprising for the S&P 500 index. But again, we would like to urge investors to kind of use that sell-off pretty effectively, to kind of use that correction to kind of time the market to kind of get back into the next bull market, which we see playing out pretty strongly in 2021, 2022. And again, to end off the Goldilocks environment I mentioned about, the fiscal support, the monetary accommodation, the vaccine that is in play that will come out in full steam in Q2, Q3 of next year, as well as the lower political uncertainty, that will be the overarching theme for the bullish narrative in the long run. And again, just to reiterate the downside risk, if a black swan event were to play out, that would definitely be a mutation of the COVID-19 virus into something that's more deadly and more infectious. Just keep that in mind. We put that in a very, very low probability event, but that could actually still play out as nobody knows the side effect of this vaccine. But nonetheless, we are still pretty long-term bullish here with that downside risk being a very low probability event. So in terms of strategy-wise, we would still urge investors, traders to kind of use again the 20 and 60-week moving average to kind of enable you to kind of time the end of this particular correction phase for the next 1 to 2 months out. And probably the ETF to kind of play this particular strategy is the three main ETF here, the DIA, which is the Dow Jones Industrial Average ETF equivalent, the SPY, which is the S&P 500 Index equivalent, as well as the QQQ for the Nasdaq 100 equivalent. And for those that want to play the current rotation that's been going on right now, the rotation out from a stay home, work from home kind of sector, which is the online kind of sector, the cyclical sector, as well as the cloud computing sector that we are seeing right now, as well as the technological sector. There's a rotation that's been happening right now, coming up from those sectors I just mentioned. The sector that's actually doing well right now over the past 3 weeks after the vaccine news has been reported is mainly these two sectors, the financial sector in the US, which is the banking sector, as well as the energy sector that has actually seen pretty much overheated kind of a scenario where oil prices have actually stayed pretty depressed. But right now with the vaccine that's been coming out, with economic expansion expected to actually be better than what the consensus is expecting in 2021, these two sectors could actually outperform the main sector that I talked about here at the top column here. And again, probably to look into these two sectors, the financial sectors as well as the energy sectors moving forward in 2021 to kind of outperform the rest of the market, or at least the benchmark in the US. Yeah, and with that, I would like to pass the rest of the time back to Colleen. And probably we can pass on to the next speaker to kind of run to the next session.
Sure, thank you, Jeremy, for the insightful presentation. Okay, just give me a moment. Let me share my slide with you guys. Okay, Jeremy will come back to join us later during the Q&A from the Q&A session. All right. Okay, next up we have our next speaker for this evening. His name is Jay Gregory from Nasdaq Dorsey Wright, the head of research and client engagement. A little bit of Jay's background is that he has been with us for more than 10 years. Okay, oh sorry, sorry, my apologies. He's not with us. He is with Nasdaq Dorsey Wright. Okay. Basically, Jay has been in the financial markets for more than 10 years. Okay, he conducts market research and also contributes to the daily equity and market analysis report. Jay has been an integral part of the research and product development team of bringing new products to the market, and also as part of client engagement efforts, right? Jay also tailor and conducts training programs for brokers and investors around the globe. Jay is also a regular guest to their local financial radio programs and a speaker at their local university. So without further ado, let us welcome Jay onto the program.
Hi, Colleen. Can you hear me now?
Yes, yes, yes.
Excellent. Okay. Apologies.
No worries.
Yeah, apologies for having some technical difficulties this morning.
Right. I guess this is the problem with technology. You can't anticipate what will happen.
Technology is a beautiful thing when it works right, doesn't it?
Yes, 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 definitely.
So hello, everybody. Thank you for joining. And I know, apologies for my technical difficulties. What I wanted to do is talk to you a little bit about what we do at Dorsey Wright, a little bit about the point and figure method of technical analysis. I know you heard some great presentation, a little bit about technical analysis. And so what I wanted to do is talk to you a little bit about what we do at Dorsey Wright. And just before I really get started, Dorsey Wright as a firm has been around. We started in 1987 as an outsourced research department based in the US, and we provide technical analysis, research, tools, and analytics to the financial community. And we work with a number of investment advisors in the US, as well as firms globally. But when we look at, when we think about technical analysis and we think about point and figure specifically, I'm going to share my screen here. When we think about the financial markets, at the end of the day, it all comes down to supply and demand. And if there's more buyers out there for particular goods than there are sellers, then prices have to rise. If there's more sellers out there for particular goods than there are buyers, then prices have to fall. And if buying and selling pressure are equal, then prices have to remain the same. And that's the same whether we're talking about stocks that we're buying, whether we're talking about goods that we're consuming, whatever it is that we're buying. And the point and figure methodology is nothing more than a logical, organized way of understanding the imbalances between supply and demand in the marketplace. And point and figure is nothing that we created. It goes back to the late 1800s, and Charles Dow was really the first proponent of the methodology, where he would write in the price of a stock into a chart paper. Today, we look at the prices of stocks in terms of X's and O's. So X's on the price of a stock represent the price of a stock is rising. O's represent the price of a stock is falling. And so on the left-hand side here, what we can see is a very simple definition of a buy signal on a chart. So a column of X's that exceeds the previous column of X's is what we see as a buy signal on a chart. And so that happens at $35 on this particular chart, or 35. Again, a column of X's right at that green arrow, a column of X's that moves one box above the previous column of X's is what we would call a buy signal on a chart. On the other side, the right-hand side there, a column of O's that falls one box below the previous column of O's is a sell signal. So that happens at 41. So a column of O's that falls one box below the previous column of O's is a sell signal. And with the point and figure methodology specifically, every single stock that we track falls into one of these two categories. So a stock is either on a buy signal being controlled by demand, or it's on a sell signal being controlled by supply. And so as we look out into the market and as we look to invest in stocks, this methodology can bring us a tremendous amount of objectivity to the investment process, because every single stock in our system is either on a buy signal being controlled by demand, or it's on a sell signal being controlled by supply. And so when we look at a chart today, and there was mention of SPY, this is what the S&P 500 ETF looks like currently. Such that the chart is in a positive trend, is trading above its bullish support line, which is that red dotted line down there. It has pulled back towards the middle of its trading band, which is that 10-week distribution. That's more of an overbought, oversold level. It's pulled back towards the middle of its weekly distribution, but the overall trend is positive. The chart continues to be on a buy signal. And so the S&P 500 right now is an ETF, is a market that is being controlled by demand. If we look underneath the surface and look at some individual stocks, like an Apple as an example, you see a very similar situation. The overall trend of Apple remains positive here. The chart is on, this is a point and figure chart. So again, a column of X's that represents the price of the stock is moving higher. A column of O's represents the price of the stock is moving lower. When you see a green box, that represents a buy signal. So that represents a column of X's exceeding a previous column of X's. And in the case of Apple, the overall trend is positive. The chart is on a buy signal. It has pulled back towards the middle of its weekly distribution. And what you're looking at on the right-hand side there is lines up with the numbers that you see on the chart. So the top, the mid, and the bot, that represents the 10-week distribution or 10-week trading band. And if you think about a normal distribution bell curve, and so if you think about that bell curve that goes like that, and you turn it on its side, that's what you're looking at on the chart there. And the middle of that bell curve, in the case of Apple, is at 116. That's basically the 10-week moving average. That's the normal position on chart. That's where a stock wants to trade. In the case of Apple, that's very normal. As it gets up towards that top, and the top in the case of Apple right now is at 142, that would be 100% overbought or 3 standard deviations to the right of mean. And so if you think about a normal distribution bell curve, again, the majority of the time you're dead center. 68% of the time you're within 1 standard deviation of mean. And so a very normal conditions right around 116 in the case of Apple. As you get more towards the overbought side of things, the probability, the more likelihood is that you get some kind of reversion to mean within the case of Apple. So if I was looking to buy Apple, ideally you buy it when it's more oversold. If I'm a trader, I would ideally buy it in the 90s because that's more on the oversold side of the ledger. And the probability is that it regresses or reverts to mean back in that 116. If I see the stock way up at 142, that is a very overbought condition for the market or for this particular stock. And so ideally, I would like to wait for some kind of pullback to mean. But when we think about point and figure charts, that they are certainly something that we can apply to the U.S. markets. But at Dorsey Wright, we apply that to the markets globally as well. We track about 26,000 securities that trade on exchanges all over the world. So not just the U.S., but on securities that trade all over the world. So here's a couple of examples of Wilmer and Riverstone holdings in terms of individual stocks that are trading on exchanges specifically in Singapore. On Wilmer specifically, the overall trend remains positive. Riverstone, again, the overall trend remains positive. Riverstone is on a buy signal, very close to giving another buy signal on its specific point and figure chart. DBS Group Holdings, very similarly, is on a buy signal in a positive trend. DBS specifically, we can see on the right-hand side there that weekly distribution, that overbought, oversold number. It was very, very oversold back in July of this year. And now as we look at the stock, it's trading way up above the top of its weekly distribution. So it's way oversold. And so as DBS Group looks, if this is a stock I was looking to buy, I would ideally look to buy it on a pullback back towards the midpoint on that weekly distribution, which right now is around 2050. But even something in the range of 2150 would put it back in more of a normal condition in terms of being able to buy the stock. And so, those are some examples of point and figure charts that we're looking at. When we think about the markets, though, one of the inherent benefits that we look at is relative strength or momentum investing. And essentially what we're doing there is we're comparing securities versus each other. So from a relative strength perspective, we can compare one stock versus the market to identify what we looked at earlier was price action. So is the absolute price moving higher or moving lower? What we're talking about now is relative performance. So is a stock outperforming the market or is it underperforming the market? And the way that we do this is through a very simple calculation. We simply take the price of a stock, we divide it by an index, we multiply that number by 100, and then we move the decimal place over. And so that calculation, that reading in and of itself is not that important. It's how it reacts to a point and figure chart. And so we can look at an example. This is Bank of America. And I won't go through all of the examples, but you can kind of look at these. They tend to be longer term when we talk about relative strength. So on this chart, on this Bank of America chart, as this chart's rising in X's, it is suggesting that Bank of America is outperforming the market. As this chart moves lower in O's, it suggests that Bank of America is underperforming the market or any stock that we're evaluating. Very similarly, we can identify trends in outperformance by identifying those signals. So a column of X's that exceeds the previous column of X's would be a buy signal, would suggest that Bank of America is exhibiting a trend of outperformance versus the market. A sell signal, which would be a column of O's that exceeds the previous column of O's, would suggest that Bank of America is underperforming the market. In this case, Bank of America has been on a relative strength buy signal since March of 2012. So for the better part, for more than 8 years now, Bank of America has been exhibiting positive relative strength. Since then, it's up about 150%. The S&P 500 equal weighted index is up about 100%. Previously, in August of 2010, this chart moved to a relative strength sell signal. So that's that red circle, that 8 right there. And the numbers in the chart just represent the months of the year. So 1 would be January, 2 would be February. In this case, 8 would be August for the month of August. This chart moved to a relative strength sell signal in August of 2010. And at that time, what it simply suggested is that Bank of America was no longer worth the single stock risk. So we were better off just simply owning the market at that time versus taking a single stock risk inside of Bank of America. That chart from August 2010 until March of 2012, Bank of America fell almost 30%, down 27% versus the S&P 500, which was up about 24, 25% during that time frame. Since March of 2012, that chart has returned to a buy signal, remains on a relative strength buy signal today. And so Bank of America is a stock that is on a relative strength buy signal. And so that idea, so every single chart that we look at is every single stock falls into one of 4 categories on a relative strength basis. So a relative strength chart can either can be on a buy signal in a column of X's. That is the strongest combination that we look at. And that's when you're looking at the slide here, that represents BX. So that means buy signal, column of X's. A stock can be on a buy signal, so longer term outperformance, but it's pulled back into a column of O's. That would be BO. A stock can be on a relative strength sell signal and in a column of X's, or sell signal, column of O's. So those are the 4 different states that a point and figure relative strength chart can be in. The BX, or the buy signal, column of X's, that is the strongest one. And what we have found over time, this is one study that we've done, is that group, those stocks that are on a relative strength buy signal and in X's, that is the strongest group out there. That is the bucket of stocks that has shown the ability to consistently outperform the market over time. And this is a study that was based on the top 1,000 stocks in the US, but we've done this study on markets globally. This is one specifically in Hong Kong, very similar study, stocks that trade in Hong Kong that we've looked at. And we see a very similar concept in that those stocks that are on a relative strength buy signal and in X's, those are the stocks that have shown the ability to outperform the market, not only all of the other groups, but outperform the market over time. So this is Hong Kong. This slide here, this is looking at Malaysia specifically in terms of if we were to break all of the stocks that trade on the local exchange in Malaysia. We break all those down in terms of those 4 different relative strength categories, those stocks that are on a buy signal and an X's. So in other words, basically the strongest relative strength or strongest momentum names, those are the ones that have displayed the ability to outperform over time. And here's an example. Top Glove is an example of a stock that obviously trades in Malaysia that has been a strong stock. We work with a group in Malaysia, and we manage some funds there, and we've owned Top Glove in those funds for a number of years, and it has been a really strong stock. It has been a tremendously strong stock over the years, has recently returned to a near-term buy signal on the chart at 862. So this chart has returned to a buy signal. It has been trading basically in a range though, and I know it's fallen back into the 7 area, but it's basically been trading in this range for the better part of the past few months. And so it's been a really strong stock, continues to be a strong stock. It's been trading in this range, and so that's something that we're watching. Top Gloves specifically as it relates to a stock that trades in Malaysia. But one of the other things as part of the overall trend technical attribute of a stock, we grade or we rate stocks 0 to 5 on a technical attribute basis, 5 being the strongest. And these are the attributes just to kind of give you an idea. But it's one of those is the overall trend. So is the stock on an absolute basis trading above its bullish support line or in a positive trend? But the other 4 are relative strength. How is the stock performing relative to the market? And how is the stock performing relative to its peer group? So that encompasses those 5 technical attributes. And if we look at a stock like Microsoft as an example, we could look at Microsoft and that we see at the top of the chart there, it's a 5 attribute stock, and that is a strong indication of positive relative strength, a strong indication of a stock that I want to own in my portfolio. And what we typically see is very similar to Microsoft, is once a stock gets to up above that 3 level, and so a stock that is 3 or higher, that is something that we consider to be investment grade. That's a stock that has more positives going than negatives. And in the case of Microsoft, it is a stock that remains above a 3 attribute stock. It has been since 2014. And we recently published a study that looks at this attribute reading. And so if you look at the chart on the left-hand side here, what we did is, going back to, we were able to go back to 1992. If we look at the top 1,000 stocks in the US market, and we bracket those into technical attribute ranges. So a basket of just buying all the 5s versus buying all the 4s versus 3s versus the 2s. What we found is that those stocks that display technical attribute readings of 3 and higher, and those are the bars on the left-hand side there, those are the 3 buckets of stocks that are able to outperform not only all of the others, the 2s, the 1s, and the 0s, but those are the 3 groups that have shown the ability to outperform the market over time. On an average annualized basis, a basket of 3 stocks is up about 9.7%. A basket of 4 is up over 10, and then the 5s are up a little over 12%. And so in terms of identifying stocks that are most likely to outperform, we look at the technical attribute reading. But what was interesting was not only did they show the ability to outperform on an absolute basis, they also showed the ability to outperform with lower volatility. And so that's the chart on the right-hand side, where the weaker, the stocks that are rated 0s or 1s actually have a higher volatility or higher standard deviation than the stocks that are 3, 4s, and 5s. And so that is very interesting. When we looked at the study, they have a little bit higher volatility than the S&P 500, but they have a much lower volatility than those weak technical attribute names. And so, that's why we look at technical attributes in terms of identifying stocks that we want to invest in. Like I said, you look at a Microsoft right now. Microsoft is a 4 positive technical attribute stock. It lost 1 attribute, but the overall trend remains positive. The stock has continued to perform well, and you can see during the sell-off back in the COVID era of when things were really coming about back in the end of February and March. The stock gave a sell signal back at 182. Again, sell signal is just a column of O's that exceeds the previous column of O's. Gave a sell signal at 180 and corrected all the way down to 134 on its chart. It returned to a buy signal at about 152, and since then it has seen this very consistent series of higher tops and higher lows, suggesting that demand has been in control of this stock since basically since the market bottom. And you see that red dotted line there. That is a positive trend line. So that's the bullish support line. That suggests that the stock has been in an overall positive trend since that time. So with that, I will kind of end there and encourage everybody, if you're interested, go to our website, dorseyright.com. If you want to take a free trial, I would encourage you to do so. But with that, Colleen, I'm going to turn the call back over to you.
Sure. Thank you, Jay. Okay, before we proceed further to the Q&A session, right, there are 2 very important announcements that we would like to make. So basically, right, in order to enhance our platform services to our valued clients, we are currently partnering with Nasdaq. And in fact, we are the first local brokerage firm to bring you basic real-time data powered by Nasdaq. Basically, this service, right, is already being implemented already. So Nasdaq Basic, right, is the leading exchange provider alternative for live streaming with best bid and offer and last sales information for all US exchange listed stocks. So with Nasdaq Basics, investors can access proprietary data product that provides accuracy, liquidity, instrument coverage, and accessibility. All right. So moving forward, most likely we will do more collaboration with Nasdaq. Yeah. So please stay tuned to look out for any of our campaigns that we have. Okay, the next announcement that we have here, hang on, okay, is we will be running a campaign for clients who are trading with us, focusing in the US market. Okay, so it's coming towards the end of the year, and of course we really value our client. That's why we are running this campaign. So from today onwards until 31st of January 2020, right, whenever clients trade US market with CGS-CIMB Securities, only for clients who has an account with us in the Singapore office. All right. So for clients who are holding an account in the Malaysia office, so we are so sorry, we cannot extend this promotion to you. But if you may check with the Malaysia office to see whether there's any promotion available. All right. So for the Singapore clients, what you can do is during this period of time when you trade US market with us, the more you trade, the higher the chances and the more you'll be able to get free shares of your choice. All right. The T&Cs, of course, there are terms and conditions that apply to this campaign. You can scan the QR code that you see on screen to access to the T&C. Okay. So apart from that, right, we will be sharing this information with you via our weekly newsletter as well as on the iTrade platform. Okay. Yeah, with that, we will now proceed further to the Q&A session. Can I invite Jeremy and Jay back online, please?
Hi, I'm back.
Hi. Hi, Jeremy. Hi, Jay. Okay.
Hello.
Yeah. Before that, right, I would like to thank the participants first for staying with us, even though it's a bit overrun already. Okay, so without delaying further, let us dive into the first question that we have. Okay, I think this question is more directed to Jeremy. Can you please give us an maybe your comment or your views on gold?
For gold, I think right now the environment is also pretty much set for the gold market to actually experience a further kind of a bull market. So in fact, what we are seeing right now, it's pretty similar to what we saw post GFC kind of expansion, where both equity markets actually experienced a bull market, and at the same time we saw gold prices also start to kind of enter into a circular bull market. So right now we are seeing that kind of a similar setup here, mainly coming out from central banks pumping up tons and tons of liquidity. So right now, it's actually more unprecedented than what we saw post GFC, whereby right now we are talking about global central banks, not just from the US, but you are talking about from the European Central Bank, from Japan, even from Australia, New Zealand. Countries that haven't really been doing this quantitative easing program are starting to kind of embark onto this unprecedented kind of a regime. So right now, we believe with that kind of a mindset and with zero interest rate policy here to stay with us at least until 2023, even further out to 2024 before we see a start of a new rate hike cycle. We believe this kind of environment will kind of benefit gold prices pretty well, at least similarly for the next 2 to 3 years out before we see the start of a new rate hike cycle, which is not playing out right now anytime soon. So quick comment for gold. I believe you should be actually looking out to buy on weakness as well for gold. And right now, it seems like gold prices are right at the bottom range of things at around, I think, $1,850. So on the technical perspective, it seems like the floor is still holding up, and you could actually start looking out to buy and accumulate some gold using the ETF GLD to anticipate for the next kind of upcycle to begin.
Sure. Thank you, Jeremy. Okay. The next question that we have here is that, okay, given the actions to tighten oversight of Chinese companies listed in the US, right? Like Alibaba, Tencent, so on and so forth, what do you think the impact on such companies will be?
So your first part, you're saying from Biden?
I think I think there is a likelihood of spillover from Trump administration to Biden administration. Yeah.
I think for that, the concern over Biden being the president enacting something that is more stringent on China is definitely not as bad as the one that is under a Trump presidency. So I think that risk should actually lessen rather than kind of a worsen, at least moving forward. So in fact, I believe by 8 December, if we do really get the confirmation that Biden becomes the president for the next term, I believe a lot of this trade tension kind of a scheme, this scare, will kind of taper away as Biden kind of take over control and be less stringent as opposed to what Trump is actually doing. So, for instance, like the one you mentioned in terms of the more stringent policy that's being tied onto Chinese companies that are listed in the US, I believe with a Biden presidency regime, that risk should actually be lower rather than higher. So instead of it affecting the stock too much on the downside, I believe that could actually be a positive catalyst for all these Chinese listed stock in the US.
Sure. Jay, do you have anything to add on, given that you are personally, I mean, like you are from US and you are there, and I think you could have more insights to share with us?
I wish I had more insight in terms of what was actually going to happen in the new regime versus now. But I know that Trump has come out and placed restrictions on investments by U.S. investors in specifically into Chinese companies. But that is quickly going to come to an end as Biden will become the new president in January, and so I think those things will likely go by the wayside, or those things will likely lax a little bit in terms of foreign investment, or at least investment by U.S. companies inside of Chinese companies.
Sure. Okay, next question we have here is, with the likelihood of passing another COVID-19 fiscal bill, how will that impact the exchange rate of USD versus other currencies?
I'll take that first. So I think the main concern over here is the national debt that is actually piling on in the US. That is the main scare moving forward, as the country actually requires more and more bailout. So we are talking about right now, if the next fiscal bill is being passed, we are talking about the second round of fiscal bill just to curb this new pandemic, where the budget deficit will skyrocket to, I think, in the range of somewhere north of 23 trillion. So if that trajectory do actually kind of stay in place, and moving forward, as and when the market requires bailout from the government, and if the government do actually pass more and more of this fiscal stimulus package that is by right increase in federal debt, that would actually have quite a negative impact, at least in the long run, for the US dollar, as your budget deficit actually continues to rise. At the same time, when the Federal Reserve is actually coming in and pumping in and buying in the treasury bonds, that would actually cause a dilution in the US dollar. And at least in the long term, that is what we are seeing from both the cyclical perspective of what the US dollar has been doing, as well as what the near-term movement that we are seeing here in the recent depreciation of the dollar over the past 1 to 2 months. So short answer to that is, if this trajectory continues, we would likely see this downward pressure in the US dollar sustaining, and the rest of the cross-currency pair would actually continue to kind of appreciate in relative to US dollar, and same for gold and silver.
Sure. Okay, next question, I think is more directed to Jay. Okay, so the question is, do you expect market to remain volatile for a period of time until the dust settles for the election? And how can traders take advantage of the volatility using the point and figure charting methodology?
Yeah, I mean, in terms of expectations, I would not be surprised to see a little bit more market volatility as we're moving through the end of the year. At least here in the U.S., we're beginning to see, I know we've seen some stuff in Europe of some cities beginning to shut back down. There are signs that some cities here in the U.S. might be closing back down for a shorter period of time, just to control some of the COVID stuff. New York City specifically just recently came out and said they're closing down all in-person classes for students, for children, for schools. So, I wouldn't be surprised to see some further market volatility as we head through the end of the year. Historically, November and December, in terms of just months, have historically been very positive and among the best months of the year for the U.S. equity markets. But with that said, 2020 has presented a lot of interesting dynamics that have been in place. But historically, like I said, November, December have historically been strong months for the market. November is certainly doing well in terms of the U.S. equity market, and really markets globally. I mean, there was a discussion about the U.S. dollar earlier, and the U.S. dollar is something that has been, from a point and figure perspective and other perspective, has been in a negative trend really since earlier this year. Since May, it moved into a negative trend. And while a weak U.S. dollar doesn't necessarily mean that the U.S. market is going to decline, but the U.S. dollar is something, a falling dollar, a falling U.S. dollar is something that certainly helps and benefits other areas. So international stocks, for instance, are something that see a tailwind when the U.S. dollar is falling. Commodities typically see a tailwind when U.S. equities U.S. dollar is falling. And so, that's an interesting point that we're going to continue to watch as we move through the end of this year and into 2021. So in terms of a point and figure chart, if you're looking at identifying stocks that are doing well, you're looking for stocks that are buying, watch stocks that are number one in a positive trend. There's about 82% of stocks in the S&P 500 that are in a positive trend today. That is a very high number. That is a very positive sign, meaning the vast majority, a lot of stocks in the S&P 500 are trading in positive trends today. But also look for those stocks that are on buy signals. So similar to what we looked at with a stock like a Microsoft, stocks that are still in positive trends that have returned to a buy signal. And again, a buy signal is just a column of X's that exceeds the previous column of X's.
Sure. Thank you, Jay. Okay, let us move on to the next question. Okay, why is it when QE1 was announced in 25th of November 2008? Okay, basically this question is more directed to Jeremy. Okay, so the stock market did not move up until March 2009, whereas when QE4 was announced in March 2020, the stock market moved up. Yeah, so
Yeah, okay, so just let's get back to history. So if you're comparing what happened during GFC, again, back then it's a financial crisis kind of environment where we saw multiple financial companies actually kind of getting into bankruptcy, which is not the case for this particular pandemic, even though we actually went through a period of lockdown. So in terms of the interbank market that has actually frozen up back in the GFC period of 2008 and 2009, that was actually a lot worse than what we've actually seen in this particular regime here in 2020 during this pandemic in March. So clearly by the fact that the market was way worse off in 2009 structurally, the first QE program that was being announced in 2008 didn't really have the kind of firepower to immediately cause a flaw for the equity market, because I believe back then there was still a lot of uncertainties in terms of when the interbank market would actually settle down and when would that default cycle actually end. Because back then you're talking about Lehman, which is a company that has 100 years of history, actually bankrupt, and talking about other banks such as Bastions, even banks in the UK such as Northern Rock, all actually went into bankruptcy. So that was actually a default cycle that I mentioned about in the presentation, where I use that as a proxy whereby we mentioned that the worst might be over after even experiencing the full lockdown in March and April. And even with that full lockdown, we didn't really see that kind of a similar market kind of default cycle that is similar to in GFC of 2009. And probably a good example that I can point off is even with that QE1 that was actually being announced this March, the market didn't really bottom out immediately. I believe the market only bottomed out the second week after the QE4 was being announced, after the Fed actually promised to buy into corporate bonds. So the market tends to kind of signal extreme kind of a turmoil, extreme panic, at least in the earlier phase of the uncertainty. And usually the first few measures taken by the central banks wouldn't be enough to immediately put in a floor for price for the market. And it would actually require the monetary authority to come through few rounds of unprecedented monetary policy for the market to actually feel safer for the kind of uncertainty to kind of fade through. So even for this particular round of QE program, I believe the QE4, the announcement on the day itself, didn't cause the S&P to bottom out. I think it actually took around 2 weeks for the market to actually settle down before that kind of a positive correlation with the Fed balance sheet expansion gels back into the kind of a risk-on mode for the S&P 500 index.
Sure, thank you. The next question is for Jay. Okay, the question is conventional technical analysis chart tend to be open close or high-low chart that plot price movements over the course of time, say from day to day. So if let's say the investor do trading in on a short term basis, right? How does the point and figure chart benefit the investor? Because based on what was presented, it appears to be looking at long term trend.
Sure. So in terms of the actual price movement, so point and figure charts are plotted based on high and the low prices for the day. But you're right. I mean, when we think about point and figure, for us, it's a logical, organized way to uncover the imbalances between supply and demand in the marketplace, but it's also very much objective in nature. And so, as I mentioned earlier, every single stock in our system is either on a buy signal or it's on a sell signal. And so there's a level of objectivity in terms of whether stock's on a buy signal being controlled by demand or whether stock's on a sell signal being controlled by supply that we can look at in terms of a point and figure chart. Whereas some other forms of technical analysis might lend themselves a little bit more towards some subjective views and inputs. But the point and figure method is something that we've gravitated towards because it's very much objective in nature. It's very simple form of technical analysis that we look at. So we're not necessarily looking at identifying day trading ideas, but what we're doing is looking at, from a point and figure perspective, identifying the big trends in the market and hopefully being on the right side of those big trends in the market, whether that's from an individual stock perspective or from evaluating various asset classes out there.
Sure, thank you. Okay, the next question we have here, more for Jeremy. Okay, so the question says, if US sell off, it is believed that STI will follow. So if this is the case, right, where do you see the support of STI to start accumulating?
Just to answer the first part, yeah, it's true that the movement overnight from the US market does affect Singapore market, and it's clear even for the rest of the market regionally, be it Hong Kong market, Chinese market, and European market. So I think there's no debate as to whether the US market will move the rest of the market. It's yes. And second part to that answer for the support for the STI. Right now, we have seen the STI actually appreciating pretty well over the past 2 weeks, purely based on the rotation again to a value kind of a sector, especially Singapore being a financial heavy kind of index, the STI. I think more than 30% weighted within the banks. So that's the reason why we saw the STI actually gaining more than 15% over a short time span of, I think, 2 to 3 weeks. And right now, it seems like it's way overbought, similar to what we are seeing right now in the US market, which is, again, if the correction in the US market were to play out like I kind of thrown out in the slides today, chances are the STI could actually follow suit, and it wouldn't surprise me to see the STI actually falling in the range of maybe, say, 5% before we see kind of the next move to the upside kind of begin. But just to keep in mind, at least for the Singapore market, the STI, it seems like the bear market that we saw at the early part of the first half of 2020 has kind of ended with the recent pickup in bullish momentum. So again, do actually make use of any correction that actually comes into the market, be it in the US market or Singapore market. And in terms of support-wise, I don't have a number off head right now because I don't remember the number. But in terms of a good proxy to use, somewhere the range of 5%, I believe will probably be where we see some sort of a support coming into the market for the STI.
Sure. Thank you, Jeremy. Okay, next question. Okay, for the near term before Christmas, right? Christmas effect, is it recommended to buy XLE and XLF now or wait until it pull back by January 2021?
For that, I think it's the same, because once we see the risk-on mode start to turn into a risk-off mode, again, if the economic outlook does kind of a dampen in the near term, where right now nobody is really expecting that, then chances are we would actually see the energy sector as well as the financial sector in the US kind of also going through a period of a correction. And not forgetting that both of that sector has actually also kind of outperformed pretty well over the past 2 to 3 weeks from the vaccine news. And right now are kind of overbought per se. So it's just overdue for a correction, and we are just waiting for the catalyst to bring through that correction phase. And to kind of give you a short answer, I think it's better to wait for the correction than to chase the market right now, and probably to buy when we kind of go through a period of correction and get in at a better price.
Okay, there's a follow-up question for XLF. So why, in your point of view, do you think that XLF will still bullish when US COVID-19 cases continue to increase?
So again, the calls that I have, at least at the summary page, are the longer term calls. And especially for both the financial sector, the XLF, as well as the energy sector, XLE. Those two recommendations are mainly from the observation that we had that there is this strong rotation that is right now flowing into both of these sectors, the financial sector as well as the energy sector. And I believe both of these sectors are being kind of underappreciated, at least for the past 6 months or so, mainly because of the kind of underperformance in the economic expansion that the market was expecting. But right now, the key changer and the game changer over here is with that positive vaccine news that we have over the past 2 weeks. There's a high probability that the economic expansion will start to pick up faster than expected. And in 2021, probably that economic expansion will be way more aggressive than the market is expecting. So at least on an economic expansion perspective, when that actually plays through, these two sectors, the energy sector as well as the financial sector, would probably outperform the benchmark, the S&P 500 index, which is why I kind of laid it out there in the summary page.
Sure. Thank you, Jeremy. Okay, next question is for Jay. Okay, the question is there any other technical indicator that can complement the point and figure chart?
Sure. There's a number of indicators that we look at that, in addition to individual charts, but there's certainly other forms of technical analysis. And I think you saw some of Jeremy's discussion in terms of other technical charts that are evaluated, that are looked at, that are very, very valuable in terms of evaluating the market. We tend to focus on point and figure specifically at Dorsey Wright, and as it relates to other indicators, I certainly didn't get into all of the indicators. I think I alluded to or mentioned some. For instance, we track the percent of stocks in the S&P 500 that are trading in positive trends, and we call those our PT, or positive trend indicators. And so if we look out today at the PT charts, the positive trends, there's about 84% of S&P 500 stocks that are in positive trends today. That is the highest number that we've seen since going back to 2013, 2013, 2014, first half of 2015 were certainly very positive years for the equity market. And what that tells us is that the vast majority of stocks are in positive trends. Historically, when we've seen a reading above 50% for those PT charts or those positive trend charts, a reading above 50% has historically been a positive sign for the market. And really all that means is that if the PT indicators are above 50%, it means a majority of stocks are in positive trends. Historically, that's been a positive sign for the market. Right now, that number is up for the S&P 500 is up at 84%.
Okay, thank you. Okay, due to time constraint, we will just take one last question. All right. Okay. The question is, would technology stocks be played down when the economy eventually recover, when the value stocks are more preferred? Maybe Jeremy first.
I would say short answer to that is no. Right now, we are just seeing that rotation where a lot of money has only been flowing into this cyclical sector, which is your technology sector, which is why over the past 2 weeks following the vaccine news, the tech sector hasn't really been doing well, pretty much just flat, whereas all the money has been flowing out into like the sector that I mentioned, the financial sector and the energy sector. But once we move through this period of rotation, and once we hit into 2021, where we have more certainty in terms of us getting out of this recession, with more quarters of economic expansion coming out into fruition, probably talking about GDP expansion more consistently in the range of say 3 to 5%, then we are talking about an environment where we are moving back into normality. And if you were to look back in history, in the early phases of the bull market, it's usually the tech sector that again outperforms most of the benchmark, say the S&P 500 index, mainly because they have a higher growth prospect per se as compared to the value stock that is right now being beat up because of that rotation. So it depends on what the environment is like in 2021. But again, if we are talking about right now, if my assumption is correct, and if we are in this early phase of this economic expansion that could easily last the next 5 years, then probably a kind of an exposure in the tech sector is still warranted within a portfolio, because again, they are high growth sector and chances are it will move along pretty nicely as the economy kind of heads further into this expansion phase.
Sure. Thank you, Jeremy. Jay, do you have anything to add? What's your
Yeah,
view?
I would just, I would probably echo some of what Jeremy just said in terms of the technology companies, the growth companies. I mean, they make up now about 25% of the S&P 500. The technology sector does today. I don't think even in a post COVID world that the companies that make up that list are going to go away by any means. I think they will continue to do well. Growth and technology as a sector is something that we're continuing to overweight within our portfolios, even though we've seen some of this near term, as Jeremy mentioned, the near term underperformance of technology in favor of some of the more value oriented sectors like energy and financials. But even when lives get back to normal, I think Zoom, I think these companies are still going to be very, very prevalent, very, very necessary in our day-to-day lives, whether it's meeting via Zoom, whether it's using Apple phones, whatever the company might be. The growth in technology innovation is not going to stop, and those companies that are the technology names will continue to innovate, will continue to find new ways to be necessary in our day-to-day lives.
Right. Okay. Thank you all the investors for sending in the questions, and thank you Jay and Jeremy for answering so many questions. Yep. So for this evening, right? Before we sign off, sorry. Okay. Before we sign off for this evening, we hope that all the investors can take a few minutes to complete the survey after this webinar. It will direct you to the page where you can take your survey. All right, this will help us to improve on our future webinars. And as a token of appreciation to you, right, for being such a wonderful audience this evening, we have also spoken to Nasdaq, and they are very nice, very generous to agree to open up limited time as free access to Nasdaq Dorsey Wright research platform for those who completed the survey. Okay, so basically, though at the end of the survey, you are required to indicate your name and email address. we will send out the link to you after you have completed the survey. Okay, so should you have any further queries on Nasdaq product and services, please feel free to reach out to them via the contact details that you see on the screen. And for account related inquiry, do not hesitate to write into us. You can write into myself. The email address is on screen. All right. Last but not least, I would like to take this opportunity to thank Jay and Jeremy for coming on the program this evening, and all the investors, traders who have joined us this evening. With that, we will end the session here. We hope to see you in our next webinar sometime in the near future. Have a great night, everyone. And thank you so much for staying out with us, even though the program is overrun for more than half an hour. Thank you, everyone. You are such a wonderful audience. Have a great night.
Thank you.
Thank you.
Goodbye. Thank you.